There is a way to do presenter mode. Let me try. I share.
Good morning, Kevin.
Morning, gents. How's it going?
Good, man.
Good seeing you again, even over Zoom.
Yeah.
Right on.
Yep.
Hey, Keith, can you? What do you see on your screen from
I
my
see
screen
you guys
share?
have the first screen up, the real workshop, how to invest.
Yeah, that's what I see as well.
Okay, so you don't see my notes or anything?
Correct.
No.
Oh, good, because I was talking shit about Kevin on my notes.
Oh, man.
I was just saying that, he don't fight real fires.
Oh, too bad I don't take anything personal, or else I think I would really be hurt by that.
He fights fires on the back nine. That's what he does.
It's funny. We actually had one last night at our station. Not good for the family, of course. That's the thing. It's such a anytime I talk to people, I always tell them, it's a really weird thing because fires is literally the most devastating thing that can happen to somebody. You know what I mean? Like, you lose all that stuff. You got to be displaced. The house is usually wrecked. And if it gets through like memorabilia or family stuff that you can't replace, like, that sucks.
Right.
But then at the same time, you're like, we want to go do what we're trained to do. So, people are like, oh, you been in any fires lately? I'm like, I'm not that excited about going to them. It's just weird. But we always like to, be aggressive and make a stop so that, we can save as much property as possible. But yeah, we had one got torched pretty bad last night, first and second floor, but we were able to stop.
Is there a way, if my house catches on fire, that I could tell the firefighters, hey, just let it burn?
Yeah, you probably could, but then you're gonna be under investigation for arson.
Okay. Darn. Okay, never mind. Forget that. Scratch that option.
This dude want to let his house burn.
I have
ask for a friend.
Yeah, I'm asking for a friend. That's right. I'm asking for Key.
Yeah.
And this is being recorded, so we're gonna have to delete that portion.
Yep, edit it out, cut it. How you guys been doing though on the West Coast?
It's good. It's cooling down now, so we're in a good stretch of fall. Like, I love the fall and spring. I actually even hate golfing in the summer because it's just so dang hot.
Yep.
Key and I went out on this past Monday.
Nice.
Yeah, I think Key, you were what, 8 under in the first before we started.
Wow. You guys are killing it.
Mm-hmm.
Yeah, it's getting cold here in Ohio. But
so do the courses shut down?
We're still able to get in. Nope. If there's no snow on the ground, they'll let you keep playing. And there is no snow right now. The weather's favorable, and it's probably, we get days still at the high. It gets to about 65. You can go out with that.
Right on.
Yep.
That is, that's something that I think we take for granted out here, which is, you can golf anytime you want, pretty much, right? And it's just, it is a blessing for sure.
Yes, it is.
I mean, we always think about, dude, if we moved out of California, where would we go? And once you've been sort of spoiled with our weather, it's just hard to find a replacement. You almost have to go to, like, I don't know, the Mediterranean Sea or something.
Yeah.
What, you don't like the winters in Columbus?
I think Columbus is, dude, I would hate to be in that snow. I used to live in New York, and you used to being in Chicago, Key. The winters, we don't like that stuff.
The first winter was bad, but year 2, year 3, you kind of get used to it. You accept your fate.
Yep. That's born and raised in Cleveland, Ohio, and in Columbus for 2. That's definitely true. I mean, it's not even a thing anymore. You're just like, all right, January, February is going to suck. March, we're turning around already, so. It's definitely, anytime we travel and we take trips and we go to Florida or California, Arizona, we're just like, wow, like people really live here 24/7. It's an unknown thing to us.
Mm-hmm.
Well, you talking about barbecues for Christmas?
yeah. Yep. But I'll be traveling a lot winter because I don't want to stop playing this year. It destroys my game. Stop playing for 3 months and then the season starts March, April, and you haven't played. It's like relearning all over again. So I said, last year that's the last time I'll ever stop playing for 3 or 4 months.
Yeah, it's tough because you lose the feel for the short game. I think that's one
all
of
it
the
is.
toughest part.
Yeah. Feel and just you can't put that club down for 3 or 4 months and come back like you used to. I mean, the pros play every day, 8 hours a day, and they still make mistakes. How much more so us as amateurs?
Right.
That's what people don't like. That's their job. A lot of those guys have a club in their hand 8 to 10 hours a day, and they still make mistakes. Golf is just that.
So you only have the club like 2 hours a day every day.
Yeah, a week. You don't go out every day. So yeah.
Hey, so Dan, Kevin was telling us that he has membership at one of the most exclusive courses in Columbus.
Yeah, no, I remember Pinnacle, right?
Yep, you got a good memory. I wouldn't say it's the most exclusive, but it's nice. But it's definitely not the most exclusive in the city. We have some crazy places here.
Oh yeah. I mean, Muirfield alone is probably better known, although as you shared, may not be as challenging as the Pinnacle Country Club.
It is. It's tougher because Jack, really wants to keep it perfect for the tour players.
Yeah.
And they really give him a lot of praise for how good he keeps that course. And they give him compliments and say, look, Jack, these are probably the best greens we see all year on tour. So it's definitely better. And I will say the best tour quality course in the city because Jack is going to make sure that happens. But there are some places that are a little bit more exclusive, though. So 2 stories that I heard recently, and I was like, wow. There's a place here in New Albany on the northeast side of the city called the Golf Club. Pete Dye was the architect, and it's 100% invite only, and it is very exclusive. If you are a millionaire, great. We still don't want you. You know what I mean? And they're like, we named it the Golf Club so that when it was open in the 60s, 50s, before the internet, no one can find it.
Interesting.
So it's it's pretty crazy.
Pete Dye's got to have designed like 90% of all the courses in the country. I see his name ever. Like Palm Springs is a big golf destination here. He's got like his handprint almost all of them.
Yeah. Yep. Pete Dye, Robert Trent Jones, some of my favorite, Donald Ross, A.W. Tillinghast, all in the golden age. Yeah, they're pretty everywhere.
Jones has a lot down there in the southeast, right? Like he's got a lot of Alabama that he's done.
Yeah. Yep. Yeah. Yeah, different time. A lot of people they try and restore them back to their original shape and how they were, and I don't know. Yep.
Oh shit! This webinar might be just Kevin Jones. Who knows? We'll see.
Maybe you got a couple comers.
No, it's all good. It doesn't really matter if one shows up or 10 shows up. So, at the end of the day, this is really something that we're going to put out to the ether. So,
nice.
It's a good way for us to practice also, and making sure that we get the right feedback, that it's impactful and it's fruitful for you guys as well.
Hey, Steve. Good morning.
Hey, Key. How are you?
Good, man. we're gonna get started in just a few minutes. We're just chit-chatting about golf and firefighting.
Oh, okay. Awesome.
Kevin's a firefighter in Columbus.
Oh, nice. Okay. Oh, looks like it's the same same as Seth, right? The other guy.
Same as what?
The other guy, I think his name's Seth, I think, from Columbus as well.
Yeah, Seth Teagle. Yeah.
Oh yeah.
Yeah, we all know him. He's pretty big in the Columbus real estate market, and he has a lot of content out there.
Oh, wow.
You could
guy,
stop
too.
at. You could just stop at saying he's pretty big.
One of the guys that I work with for my W-2 job, he lives in like Delaware County, I think, in Ohio. And they say it's like what, fastest growing county in the area? Is that where you guys at, kind of thing?
It's north of Columbus. It's probably 25 minutes north of Columbus. But yeah, it's really nice up there. It's probably the fastest growing just because in years past it was very wide open country, and so a lot of developers moving up there because we got Intel coming in, and then Honda just announced they're building a chip factory.
Wow.
So that's where a lot of space is to build new.
Yeah, it's kind of interesting. It's like middle of nowhere. It's like landlocked, right? But the company's coming in, so it's pretty interesting. What attracts them, kind of thing.
Yeah. Major growth for sure.
Yeah, I met Steve through networking on Facebook. And Steve, I think you're doing one of your first like larger multifamily deal out in the Kansas City, Missouri.
Yep, Kansas City, Missouri, on the Missouri side. We recently.
Cool. When did you close on that?
We closed it 2 months ago. It's like a 12 units to start. So I thought it would be a good kind of entry point into that multifamily kind of thing. Initially, I was thinking like, getting like 40 units kind of thing to really count. I think it's with the 12, it's a little bit more manageable with getting into it, and then knowing the bankers and everything, getting the commercial loan a little bit easier for that to start, and I think so. Yeah.
And you are in Colorado, was it?
Denver. Yep. Denver is
Denver. Yeah. Cool. Yeah, I remember Denver used to be really small back, like 10, 15 years ago. I was based out of Denver, for my day job as a pilot, and I remember they were just starting to build around the airport, and now there's just houses and apartments everywhere.
Yeah, by the airport, it's what they call the Green Valley Ranch kind of neighborhood. Back then, it was like, the people who got priced out, and they'll move out there because it's cheap. Now it's like it's not cheap anymore because it's kind of like all the developments moving that way as well. Companies, Panasonic, some other big. I think they opened up a big Gabriel hotel that it's like a huge one, right? They're out there for conventions and everything. So yeah, it's interesting.
Okay, cool. All right.
So we'll give it another minute, and then we'll get into it.
Cool.
It's always cool to do these things and kind of see where it ends up, what it ends up becoming. Actually,
right.
So we're 5 past the hour. So I think what we could do is just get into it because we've got a bit of intro and then people can join in into the sort of heart of the presentation. So, everyone, thanks for making time today. I'm really happy that you guys could make it. You don't have to stay the whole session. I think I'll kind of outline what we're going to go through through this time together. But I think the people that we invited really are the ones that had shown a lot of interest in wanting to learn about what we do, how we've grown, and really how we began our journey. And I think that's really important for everyone. Aside from just the fact of really looking to make money, that there is a sorry, I'm just going to turn off my phone, that there is a greater vision behind it. So, with that said, let me just go through a couple of housekeeping items. So if you guys can just keep your phone on mute, computers on mute throughout the presentation, that'd be great. We are going to answer questions at the break. We're going to have one break and at the very end of it. So in order to keep the flow going, hopefully you guys can write down your questions in the chat box, and we will answer all of those questions. And I think, if you have questions, I'm sure everyone else has the same questions too. So it'll be great for us to get at it together. Let me see. With that said, we planned for 9 to 12 today. We don't know actually how long we will take. Maybe we'll get through it in an hour, maybe 2. But as long as we have questions or whatnot, we'll be here for that time period. So Key, anything else before we get started?
Well, maybe we can talk about, what we're going to cover today, briefly.
Yeah, I'll get to that. But before that, I think it's important to ask the question, are you ready to make some money? I think that's the most important question of the day. All right, I guess there wasn't that much enthusiasm there. So let me ask another question. Are you ready to make a lot of money?
Oh yeah.
Yeah, there we go. That's
Yes.
that's what gets everyone amped up a Saturday morning, right? Actually, that is the furthest thing from the truth of why we're here. Really, I think it's really important to ask the question about what this workshop is and what it isn't. It's really going through our experiences to help you guys to build a healthy real estate portfolio. And we're not coming from a perspective we're sort of the know-it-alls, whatnot, but we have spent the last 3-4 years really building this business, and we'll go into detail about that. We are particularly involved in multifamily real estate. And as many of you guys will understand, the breadth of the different type of real estate verticals is very vast. And there's no way, that we could become experts in all of those. But so we'll just cover the one sub-vertical that we know pretty well, which is multifamily real estate investing. And we'll cover what it takes from you to really get fully immersed into this field, right? So what we're going to cover throughout this boot camp, and by the way, we're looking at this as a 3-part series, just to make sure that we break it up so that everyone has enough time to digest it. We're going to cover about our story of how we got started, why we really love the real estate industry, the strategies that we've deployed and we continue to employ and refine, how to find and evaluate the right investment property for yourself. And best of all, we'll walk you through how to acquire your first property. So as I mentioned, this will be a 3-part boot camp. And for reference, we're going to do it kind of on a monthly cadence. And so our next session will be on November 19th. That's what we've planned for so far. All right. So who is Elevate and what is Real Workshop? And this might be the first time you're really even getting a sense of these two entities. So Elevate, let me cover what Elevate is first. So a little bit about us. I'm Danny, and I am a former investment and corporate banker, and I oversaw the relationships for Bank of America Merrill Lynch for Fortune 500 companies for past 17 years. And Key was my personal pilot that flew me around the world. And that's my story, and I'm sticking to it. No, actually, he has a way more interesting background than I do. Actually, he is an airline pilot, commercial airline pilot, but that's his alter ego, because he was actually a professional poker player and used his pilot skills only to fly himself around the world for poker tournaments. So, with that said, we brought together a very sound financial analyst from the banking world with an analyst of high stakes gambling. And we formed this beautiful harmony of real estate underwriting. So I just want you guys to know, if there's no gamble, there's no life. But on a serious note, there's a lot of similarities. And I'm sure Key will expand on how he used his analytical skill sets in poker and really translate that over to real estate. Because, in real estate, when you look at properties and investments, you don't have perfect information. And what you have to do is really attain value from what you know and the probabilities of the outcomes in the future. So that is, the story behind, our background. But what really brought us together was actually something called the Buddy Pass. And I don't know if you guys know, but the Buddy Pass is the privilege to fly literally for free anywhere you want, just because you know a pilot. And so if there's anything you could take away from today, that is get to know a pilot and have him as your friend, because that is the biggest benefit in life. But what really happened is he and we would really spend the last 4 years or 4 or 5 years. Actually, it goes back further than that. I would say like 6, 7 years, where we would have the opportunity to go fly together, and we go to different destinations. And one of the coolest things was that we would always show up to the airport with cold weather and hot weather clothing, because we didn't know where we'd end up, because the limitation to the Buddy Pass was that you can only go to anywhere as long as there was a seat available. So we just had to be really flexible with that. And during those times, sometimes we wanted to go to Europe and we'd end up in Guanajuato, Mexico. And sometimes we'd want to go to Japan and we'd end up in Australia, on the other side of the hemisphere. So, it really got us to realize that we're pretty flexible people, that we can think creatively and work, on solving issues, right? Because there's been a number of times where there was only one seat left, or, 2 seats left, and we'd have to really think creatively in those times. But what ended up happening is that we spent a lot of time talking through our lives, and we kind of hit a point in our life where we were in a bit of a lull. I guess we were kind of about late 30s and entering into our 40s, and we felt that we were living day to day to make money, and that's what we were doing, right? We were basically in professions or careers that was there to sustain our livelihood. But we really wanted to do something more that would be an investment for the future. And we both had this passion to want to build community, and not just any community, but community of people who we can impact directly and who we could be impacted from. And so we could help each other flourish. And so that's why we really thought that at that time, that real estate would be the answer, because it really coincided with Key wanting to 1031 out from his holdings, and me myself, I had some real estate too. And so that's what we were going to do. So that's how Elevate came together. This was in 2019, and we did our first purchase in 2020. We'll go more into that. What is the mission of the Real Workshop? So Real Workshop is an extension of that. So what Elevate is our investment company, the Real Workshop is what we will build out to be more of an education platform, and where we can share a lot of information, and we can really be helpful in helping you guys to flourish in your real estate journey. So that's essentially, in a nutshell, what it is. So with that said, are you ready to make a lot of crazy money? That didn't come out so good. All right, well, let's go. I'm just crazy. I'm crazy this morning. Let me try to get to that. So let me talk about kind of more maybe of my personal journey first. So I started actually with my first investment property in 2010. and this was in Los Angeles. It was a duplex, and I bought that for $750,000, and I put in about $250,000 for renovation. And this year, I actually sold it, and I sold it for $2.2 million, and that was actually the highest price per square foot in that neighborhood. And so did amazing, right? I had also purchased a condo in 2012 for $170,000. That was cash, and so sold that. Actually, and you'll hear our story, but sold that to co-invest with Key and to start Elevate. And this was in 2019. That was a good gain as well. And so if you see the total value that I had basically in transaction volume was 2.6 million throughout the 10 to 12 years. So started in 2010, sold everything pretty much by 2022. So 12-year run at 2.6 million in real estate. The paradigm shift happened when we started together. We came together in 2020, end of 2019, pretty much, but first transaction in 2020. And we started with 730,000. That was from 1031ing from our properties. And since then, we acquired over $22 million of real estate. And so when you look at that paradigm shift, it's pretty phenomenal, because even though I might have done well in my personal real estate, that was more of what you call maybe passive investing, where I had my own, job, W-2, and was really looking to just have real estate on the side, right? But what happens when you really focus on this and really go all in? And this is what happens. And actually, the most beautiful part about this is not the amount, and I just share the amount because it's an indicator of our progress, right? We're not proud of that. What we're, I think, proud of is really mostly the communities that we built along the way. We built amazing relationships with other investors, other people that want to get in the game, our property managers, the vendors, the contractors. And this is exactly what we wanted to do in terms of building our vision for the company. We build community with the people we touch and we come across. Furthermore, we've really been trying to improve our skill sets in real estate so that we can give more value to tenants. There's a ton of apartments out there and a ton of real estate out there where the owners don't care. They're just trying to eke out as much profit as possible. And for us, what we felt was we wanted to inject capital, invest capital to give tenants a better livelihood, and so that everyone ends up in a win-win situation. So in any case, along the way, we've deployed a total of 1.3 million. That's through other earnings, cash flow, et cetera. So just to give you a kind of a fuller picture. So that's a lot. Thank you for sticking with me through that. And what I think we can get now into is really why we love real estate. And, this isn't just a personal, kind of feeling. Key's going to really go through the meat and potatoes of, why we really enjoy investing in real estate.
Yeah, why do I love real estate? It's one of the oldest asset classes out there. I mean, we've been fighting for pieces of land for millenniums, and everybody needs a place to live, whether you're rich, poor, through recession, through economic boom. We always need a house. So we're investing in a tangible asset that provides basic human necessity. The thing about shelter is that it's very limited while our population is growing. Last time I checked, we are just growing in population at a pretty rapid pace. Unlike other animals, we don't really have predators. We're at the top of the food chain. So nobody's really killing us. We're not really killing each other like some of the other animals. And through advanced in medicine and technology, we're living longer. So there's a lot more people being born than dying. And there's just limited land. Last time I checked, we're not building any more new land. So unless we discover Mars, we're stuck with what we have. In essence, this creates a major shortage. We have finite supply that's not increasing, and we have progressively increasing demand for housing. Back in 1980, the world population was 4.4 billion. Today, we're looking at more like 7.8 billion. In 40 years, the population nearly doubled. US alone has shortage of about 3.8 million units. And this Basically, we're investing in a finite, an asset with finite quantity that has increasing demand year after year. And with real estate, it provides a hedge against some of the ups and downs of the economy, as well as the inflation. I have personal experience with this. My first property I bought in 2007. And if you guys know the importance of it, there was financial crisis and real estate crash in 2008. I bought this house for $120,000 in a Podunk County, Utah, called Washington Terrace. I hope nobody's from there. I'm not knocking on Washington Terrace, but as soon as I bought it for $120,000, the valuation just plummeted down to $90,000. In 2008 or 2009. And this was my first real estate investment. And that was not fun, let me tell you. What I did was I held on to the property because it was at least cash flow neutral. I didn't sell it. If I sold it then, I would have sold it for a loss. And among many things that I learned from the property, I took away two of the biggest lessons is that cash flow is really important. And it's important because even if the valuation decreases, as long as it cash flows, it can help you sustain throughout the downturn. What happened is I held the property for, I bought it in 2007. I sold it in 2019. So I held it for 12 years. And eventually the price went above my initial purchase price. I ended up making nice profit on it. So even though it seemed very very dismal when the crash happened, by holding on to it, the price eventually went up. I was able to make good profit. And if I can make profit on this property, it gave me confidence to really excel. Like I thought, if I can make profit from this bad investment, how much better can I do if I did a little bit of due diligence, if I got a better deal, if I perform better on it? So this deal just taught me the importance of cash flow, as well as giving me the confidence that real estate actually works. Even if I don't get the best price, don't buy in the best area, and buy during the worst time, the price eventually goes up and there's ways to make profit. Right now we're going through just record inflation. And the thing about real estate is that the rents and the asset prices are tied to inflation, where our grocery bill goes up, our gas prices goes up, but guess what? Our rents also goes up. And rents are directly correlated to the valuation of real estate. So it's a real tangible asset that provides hedge versus inflation as well as recession. And the other thing that's really cool is that it gives us the chance to impact the returns. It's pretty hard to do that on, when you buy Tesla stocks, right? What can you do to have a direct impact on the performance of the asset? But with real estate, we have a chance to get creative where we can impact the outcome or the performance of our returns. And I think for somebody who wants to hustle and be creative, it's there's a lot of opportunity. And there's something to be said about asymmetrical potential. Dan really loves big vocabulary. I'll let him expand on that a little bit. So what do you mean by asymmetrical potential, Dan?
Yeah, so many times, when we look at investments, right, I would say the vast majority of people want to beat the market returns, right? And they want to lose less than the market returns or market losses, right? So if an asset, let's say stocks, real estate, whatever, were going up by 10%, they want to be the ones that are getting 20%, right? But if it's going down by 10%, they want to only lose by 5%. That's the asymmetric potential that most people are trying to seek after. And that's why you would pay private equity or hedge funds their premiums so that they are able to generate asymmetrical returns.
Right. And in order to achieve asymmetrical return, there's what I call the 5-prong approach to profit. The first three, you're probably very familiar with: cash flow, principal pay down, and market appreciation. Just to touch on them briefly, cash flow is simply rent minus expenses minus mortgage, whatever's left over each month. That's cash flow. The principal pay down is you take out a loan on the property and the tenants are paying down the mortgage. Over time, you will eventually have the property paid off. Market appreciation is simply appreciation of the asset based on inflation and the comps. You buy a property, 20 years ago, you can probably buy it for pennies compared to now. So over time, real estate and other tangible assets just appreciate. Now, what gets me really excited about real estate is the two other appreciation, which is not nearly as well understood, and that's forced appreciation and tax advantage. The difference between forced appreciation is versus market appreciation is that market appreciation, you really don't have control over how much something appreciates. It really depends on what comps sell for. What did next door sell for? If next door sold for 900,000, your house is probably worth about 900,000 if the configuration is similar. And over time, we enjoy market appreciation, but forced appreciation allows us to dictate what that appreciation is. Imagine buying a beat up car and restoring it and adding value and selling it for profit. Well, this is pretty similar. The thing about forced appreciation is that it's a lot higher in magnitude compared to market appreciation. What we look for are assets with under market rents. We go in, renovate the units, get higher rents for higher cash flow. But the higher cash flow is only a small portion of the equation. Commercial real estate is based on, the valuation is based on the income that it generates. So the more income a property generates, the higher the valuation becomes. So by raising rents, we increase the cash flow and the asset valuation, and we can enjoy very high appreciation over a short period of time. So forced appreciation is one of the biggest components of this five-pronged approach.
Yeah, and I'll add, Key, that the way that we approach all of our properties is almost like it's individual business. And so whether it's buying a dry cleaners or a liquor store in an area, the goal is to increase the revenue and proportionately reduce expenses. And so each one has its own unique approach. It's not sort of a similar approach to every single one. That's why the task of really underwriting and evaluating every property is just like buying a brand new business.
I agree. And that also opens up room for creativity and hard work. Whereas, if you're investing in other asset class, let's say stocks or cryptocurrency, you're kind of evaluating, what are the chances that this thing's going to go up? But with real estate, you have a chance to think of ways to improve its performance and make it into reality. And I think that's what makes it fun. And it also gives, the chance to really, test out their thesis. So forced appreciation is huge. The other thing is tax advantage. And, I'm not sure how much you guys are familiar with the different tax advantages, but the government wants to partner with real estate investors. Why? When real estate investors make improvements to existing buildings, when they build new houses and apartments, it creates value for the society. So the government wants to encourage investors to put their money into different deals. So the government is offering very enticing tax benefits to real estate investors, and they want to partner with investors. There's a lot of tax advantages that's simply not available to other asset classes. I'll touch on two just briefly. One is the 1031 exchange. When you buy an asset and you sell it for a profit, Uncle Sam wants a piece of it. Hey, you made profit? Great. Let me get my share. With 1031 exchange, you have the opportunity to defer your capital gains tax. Let's say you bought a house for 100,000 and you sold it for 200,000. Well, there's a gain of 100,000. Instead of paying taxes on that, you can roll that into the next property And this allows the growth to be a lot more exponential. And you can continue doing 1031 so that you can defer taxes in perpetuity. Another big tax advantage is depreciation. And a simple way to think of depreciation is if you buy some sort of equipment for a business, you get to depreciate its value over time. Well, a building is considered an asset, and you can depreciate the value of the building over a period of time. And while the price is actually appreciating, for tax purposes, you can depreciate and offset some of that income. And there's special depreciations called, accelerated depreciation and bonus depreciation that allows you to front load a lot of these depreciation so that you can have huge paper losses, for to offset any gains or income. So we'll get into the details of that later, but just the two alone, the 1031 exchange and depreciation, is a very powerful tax advantage. One of the things about real estate is that it sometimes doesn't offer the liquidity. Like it's not easy to sell $1 million property, right? But the way to get around that is to do a cash out refinance. And when you sell a property, you have to pay capital gains. But when you take out a loan, there is no tax on the proceeds for the cash out refinance. So there's just different ways to, I wouldn't say avoid taxes, but enjoy very good tax advantage when it comes to real estate. The levered return. Leverage, right? Leverage is a pretty, I don't want to say sensitive, but very heated topic. I think Charlie Munger once said, 3 L's, be careful for 3 L's because they lead to all demise. I think it's liquor, ladies, and leverage. But leverage is what I would consider a double-edged sword. For those who know how to wield it, it becomes a very powerful tool. And for those who can't handle it, it can become pretty dangerous weapon. So depending on how we use it, we can supercharge our returns. As savvy investors, leverage can be an amazing tool. And with real estate, leverage is a big part of the game. Let's imagine that you walk into the bank and say, hey, Mr. Banker, I love Tesla stocks. I think it's an amazing company. Elon Musk is a genius. I think we can make a lot of money if we invest in Tesla stocks. I want to buy $1 million worth of Tesla stock. Can you give me a loan for $800,000? I put up $200,000. Let's go buy Tesla stocks. How do you think that conversation is going to go? I can tell you, it does not go well. And they're going to be like, hey, get lost, right? But what if you walked in and said, hey, Mr. Banker, there's this 10-unit apartment around my neighborhood, that's cash flowing. It's got 15 units, and I like to purchase it. Do you want to put up $800,000 for my $200,000? Well, guess what? That tune's going to change very quickly. Banks love lending on real estate. And if you think about it, it's a pretty good arrangement. They're bringing most of the money, and we're only putting in a fraction of the money, and we get to keep most of the profits while the bank makes small amount just on interest. And honestly, I can't think of too many better partnership arrangement than that. And that's one of the huge advantages of real estate. We talked about appreciation earlier, market appreciation. And historically, market appreciation is only about 3% a year. And you might think, man, that's pretty low compared to the stock market, which has done anywhere between like 8 to 10% historically. But you have to remember that the appreciation on real estate is on the price of the asset. So if you have $1 million property, it's appreciating by 3% or $30,000 a year. But you didn't put up $1 million to buy that asset. We can enjoy levered return because we only put in a fraction of the purchase price to purchase the asset. We might only put down $200,000 for that $1 million property. So when we deploy $200,000, we enjoy the 3% appreciation, which is 30,000, which becomes more like 15% return. So this is power of leverage. Earlier we talked about the benefit of cash out refi, where we may not be exposed to taxes. So just using debts in a responsible and creative ways can help us accelerate our returns. Another thing I love about mortgage and debt is that it's inflation proof. Over time, rents go up, but guess what? Mortgage stays the same. So, let's say you bought a rental property, the mortgage is 1,000 and the rents are 1,200. The mortgage is going to stay 1,000, but the rents are going to go from 1,200 to 1,300, 1,400. Year over year, your cash flow is going to increase. So I think of it as a mortgage payment. We're paying progressively less as time goes by because the value of money is eroding. And last but not least, real estate, it's all about community. And Dan, what do you think? I'll let you kind of expand on that a little bit.
Yeah, sure. I think we've overused the word community a lot today, but I think it just resonates, to say that this is why real estate is tremendously interesting to us, right? Is because it's a team sport. And, many times, like for example, even I give you guys the example of my property, and because I live in LA and it's in LA, I, obviously didn't employ a property manager. I thought, hey, it's only 2 units, I can manage it myself. But that's very difficult to scale. And many times we rely on the how. So how can I get this done? How can I increase rent? How can I repair this leak that's happening, right? But yet over the past few years, we've learned about the who. It's about who can I call that can manage this whole process for me, so I can worry about growing the portfolio and buildings. And so, in many times, the way that we look at it is, we're looking for good teams, good partners, right? And that's not just on the vendor side, it's also on the investment side. We look to partner with other investors, right? So, one of the verticals, for example, that we're looking at right now is to get into, mobile home parks and different asset classes. Well, we are not looking to try and go learn everything about it, right? What we're trying to do is find the who, like the partners that we can work with that are experts at what they do, so that it really saves us a lot of time and mistakes and headache, right? And, furthermore, part of our mission is really to be a positive influence and mentor to many people. And so when you work with a lot of people, you're going to get the spectrum of, quality, right? And so you've got A players, B players, C players, etc. The job is not really to get rid of all the C players. It's also our mission is really to say, how do we put them in the best position to win? Whether it's really trying to train them or give them feedback, et cetera. And so it really becomes a team game where, you want the weakest link to strengthen. I will also say it's one of the only fields where you don't really, you have competition, but you don't look at others as competitors in the way that you would in many other situations. For example, if we're looking at an apartment building and we know others are looking at it as well, sometimes we will look at the competitor and say, hey, do you guys want to partner up? Because by doing that, if we respect their, let's say acumen and their history and their character, their integrity, why not? We can get more deals done by partnering up with them than trying to tackle it individually, right? And that can also scale us from getting $2, $3, $4, $5 million properties to $50, $100 million properties. So it's amazing how, when you meet other investors, right, you're looking at them as potential partners. You're not looking at them as competitors. And same thing with everyone here on the phone. We're not, the reason why we feel, really good about teaching this concept, we want you to succeed. We want you to flourish. And hopefully we can all flourish together by working on deals together in the future as well. So this is how we create win-win situations for everyone, and we are able to collaborate and build community.
Yeah, Dan, I can just think of so many different instances where, we had no idea that a casual encounter would lead to introduction to important broker, lender, property manager, and how some of those people brought, deals, introduced us to ideas that we didn't know before. Even just getting started in the apartment business, I was trying to do a 1031 exchange to sell my threeplex to buy fourplex, and somebody in Bigger Pockets community approached me and said, like, hey, why are you trying to buy 4 units? You can buy apartments. And just by him saying that, it planted a seed in my mind that it was even an option, where I didn't know that it was even possible. All that to say, these conversations that we have, these connections that we make, these relationships that we build just has infinite returns. And we have no idea where how adding value to other people will come back later in some way, shape, or form.
Yep, well said. And with that, we had planned a break at this point, and the next section, what we're going to actually get into is really about market selection, repositioning, and deal flow. This is going to be a bit more technical. So let me just stop here and see if anyone has any questions from the previous section that we just covered. We could spend the next 10 minutes. If you need a restroom break or a water break, go for it. But if you've got any questions, feel free to ask at this point in time before we get into the next section.
Hi.
Hi.
Hi. I just had a question about what earlier you mentioned one of the reasons that real estate is great because the mortgage rates don't go up with inflation. You're locked in for 30 years. But when it comes to, for example, the type of properties that you're investing in, larger apartment buildings that would fall under commercial deal, so the mortgage is renegotiated every 5 years, right? So how do you kind of inflation proof that, make sure it doesn't go up crazy? What are some things you could do?
That's a good point, and we will discuss that more in detail when we talk about loans. But I was talking more about the fixed rate mortgage, that most people are used to. That's locked for 30 years. In commercial real estate, it's rare to find like 30-year loans. They do exist. Most of them are more like 10 years, 7 year, or 5 years, and but that's why you can. I mean, you have a lot of options. You can sell or you can refinance at the end of 5 years, and it's all relative, right? Where you can have 1 to 3 year loan, that's a bridge loan, where you have to refinance. Versus 5 to 10 year loans is more of a long term. So long term debt, fixes the mortgage payments, for the duration of the loan. But I mean, technically, you are right. Some of the commercial loans are shorter in duration.
Yeah, and I'll add, we talked about each building and property being its own business, and the way you also approach debt to fund, or debt and equity to fund those deals, have to be correlated, or I would say relative to that asset that you're investing in. So just to give you an example, if you're buying a stabilized building, then you'll look for a long-term debt. You may even pay points up front to just keep those keep the rate locked for a longer period of time. But if you're looking at a heavy value add property, then that debt equation becomes very different. Whereas Key mentioned, we might go with a bridge loan, and a bridge loan is typically higher in interest rate, but they'll also give you more money up front so you can use it for your construction. So it's a difficult question to ask, because we can't really predict the future in terms of where we'll be 5 to 10 years from now, but we can see what type of strategy we're going to deploy on the actual asset that we're acquiring at that point in time. All right, Professor Key, you want to lead us off here in how we go about selecting the markets to invest in, and we could talk about how we chose our markets. So
Well, the most important thing in real estate, the three most important thing is location, 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 right? Well, maybe it's a little bit of a nuanced statement. It's not that black and white. I mean, in any location, in any good market, there's always bad areas, and in any bad cities, there's good areas. So it's a lot more neighborhood specific, and it also depends on the plan for the project. So with that said, when we enter a new market, there's several criteria that we're looking for. Dan has the 5 most prominent considerations that we have when we select a new market. The first one being population. We want to be in areas where the population is growing, and not just growing in numbers, but having positive net migration. So, I mean, organic growth is just a lot more people being born than dying. But what's important is net migration, where more people are moving into the area than moving out. And that indicates a desirable market where people want to move to. And a lot of this information is available online, especially for net migration. Even if you go to like U-Haul, they show you where people are moving to, and can give you an idea, where you might want to invest. Because more people means more housing, means more customers. Closely tied to that is employment. And again, with employment, we're not just looking for the number of jobs, but the diversity of jobs. Having employment is important because it's a way to make living. People flock to where there are jobs. When you look at the animal documentaries, all the animals, they congregate to where there's food and there's water. For people, jobs, employment is our watering hole. Wherever there's jobs, that's where people go. Now, it's not enough to just have high number of jobs, but you want to make sure that there is diversity in jobs. And we're not talking about anything politically correct, but just meaning that we want to see a lot of different sectors and a lot of different companies that provide employment for the market. The reason being, if there's not enough job diversity, a downturn in that specific sector can become disaster for the economy, for the city. For example, there's a city in southern Illinois called Peoria, and I forgot what the exact percentage was, but something like 60 to 70% of the people work for Caterpillar. So if something bad happens to Caterpillar, Peoria is in big trouble. So we want to make sure that there's a lot of different sectors and a lot of companies that give people the variety as far as employment is concerned. The next thing we want to look at is the legal landscape and taxes. And we want to know what kind of laws exist for tenants and landlord. It's not that we only want to invest in places where they favor landlords, even though that's preferred. If you're going to a place where the laws are favorable for the tenants, we at least need to know and how to mitigate for that. For example, in California, especially in LA County, I believe, correct me if I'm wrong, but you cannot displace a tenant when their lease is up. So let's say you have a tenant, their lease is up in December. You can't say, hey, your lease is up, I need you to move out, because tenants have rights. So unless they violated the lease, they have the right to stay there forever, indefinitely. And there's limit on how much rent can be increased year over year. So for some tenants, they've been living in the same place for, let's say 20 or 30 years, and they're paying well below the market rent. And there's nothing the owner can do to get them out so that they can get new tenants. So if you're investing in places like LA, you need to know how to mitigate, those laws. Same thing with taxes. There's different property tax rates across the states, different cities. In California, I think it's pretty low, like 1%. maybe even lower. In Reno, I know it's very low. It's under like 0.5%. And then in places like Dallas or even in Columbus, property taxes are a lot higher. It's like 2.5%, 3%. But more than just the tax rates, you also have to understand how tax is reassessed. I'll give you a quick example. In Columbus, when you purchase a new property, the property tax is based on the new purchase price. Where, if the property was valued at 1 million previously, but if you buy for 2 million, your property tax is going to double. In places like Reno, the tax does not get reassessed upon sale. So whatever the property tax was for the previous owner, the new buyer can expect to pay something very similar. So there's a very different method to underwrite depending on how taxes work in that particular market. So needless to say, these are very important details that we want to pay attention to. Supply and demand, it's pretty simple economics. We want to be very aware of the supply and demand of rental units of a particular market. In some markets, the supply is physically limited. Think of Los Angeles, San Francisco, or Boston, where you physically cannot build, due to some obstruction, whether it be, water, mountains. And also, we have to be mindful of how many permits have been given to build, new apartment units, and compare that to the demand of the market. And the supply and demand dictates the vacancies and the rental increases of certain market. Finally, there's some other considerations, right? Like median income compared to the rent, which is very indicative of, the affordability of certain area. And also, we want to pay attention to the crime rate. And the last but not least, hipsters. That's one of the favorite hot buttons for Dan. Dan, you want to elaborate on that a little bit? Why do we care about hipsters?
Well, we're always trying to buy in the path of progression, right? So as we were talking about location, it really depends, because even within a city, there's areas you don't want to invest. You don't want to buy just, let's say, for example, in Columbus, where we know, or Reno, just because it's within that city doesn't mean that you should automatically purchase. You really want to be in an area that's actually being developed with security and other investors coming in, and be hopefully a little bit early on that. Now, I'll add a couple things here on the legal landscape and taxes. That's something that is incredibly important, and to become an expert in those areas, it's difficult, right? And that's why one of the things we say, it's hard to just pick any market out there that's growing. For example, many of you guys heard about Phoenix, Arizona, Austin, Texas. Many cities across the country that are growing and that have grown tremendously. But to understand the legal landscape of what you can do from a rent perspective and taxes perspective, that is key, because I've seen people who will get reassessed on their taxes, and it totally just ruins the investment because of whatever. These days, another consideration that needs to be thought about is insurance. With the large amount of natural disasters happening, like across Texas and these regions, the insurance prices have skyrocketed, and they've more than doubled. And so, looking at flood zones, gas emission zones, all of these things come into play. And so, when we look at a market, this is generally what we're looking at in terms of the guidelines, but there's a lot more specific work that needs to go in. Let me just kind of bifurcate between a couple different market types, right? So we've got the premium markets, and that's really a lot of the coastal lands, Los Angeles, San Francisco, et cetera. And then we've got secondary markets where we typically thrive in, which is the Midwest and just lower cost areas. And the differentiator, and this is just general, anecdotal, is just that premium markets are going to have the higher market appreciation, and secondary markets will have lower market appreciation. But on the flip side, you've got probably lower cash flow coming out from premium markets, because you're paying more for each door, and you probably will have lower leverage because banks are going to lend based on your cash flow. If you got lower cash flow, well, your what's called a debt service coverage ratio is going to be lower. And whereas secondary markets, because you're buying it at a cheaper price, you typically will cash flow a little bit better, and that means banks will lend more to it. Across both of these markets, though, the one strategy that we always would look to deploy is called repositioning. And that's basically adding value or value add based upon your expertise in knowing how to implement the right amount of capital for the return. I'm going to let Key talk about the value add process.
Yeah, I love the value add approach. In my mind, it combines the best of the both worlds, the high cash flow and high leverage of the secondary market, along with the strong appreciation of the primary market. The challenge with the primary market or the premium market is that the price per door is much higher in proportion to the rent. So as Dan explained, it's harder to cash flow. The strategy is very different in the premium markets, where some investors are content with lower cash flow or even no cash flow because they're just banking on the appreciation. And that becomes a big part of their investment thesis. So what we did was we took this value add approach to secondary markets where we can enjoy appreciation as well as cash flow and higher leverage. And I touched on this a little bit earlier with forced appreciation, but it's a chance for us to increase rents or increase revenue, which not only increases our cash flow, but more importantly, it increases the valuation of the property. Any property with more than 4 units are considered commercial, and commercial properties are valued differently than residential. Residential properties are based on market comps. Similar 2-bedroom houses sold in the neighborhood for X amount, and 2 bedrooms will probably sell for a similar amount. For commercial properties, the valuation is based on the income that it generates, similar to a business. So the more income a property generates, the higher the valuation you're going to have. This gives the investor a chance to directly impact the returns of their asset. The more rent that you can increase and the less expense that you experience, the higher the valuation is going to be. Just to give a quick numeric example, if you were to increase rents by only $100 across a 100-unit apartment complex, that results in $2 million in increase in valuation. And $100 in rent seems pretty small, but that results in this massive increase in value. And this is done. This is broken down like this: $100 for 100 units equals $10,000 extra income per month, which is equivalent to $120,000 a year. And $120,000 extra income is nice, but this results in $2 million valuation because we're going to get into this later, but we divide the income by what's called a cap rate. And this is think of it as some sort of a metric on how much return an asset is supposed to generate in the market. So, right now we're using about 6% cap rate. So based on 6% cap rate, $120,000 income will result in $2 million increase in value.
Yeah, and I'll interject, like something to keep in mind. We're using the word rent here, but this is income. So one of the good things, as we mentioned, we're buying a business and we're looking to see if this business can absorb additional services. So meaning that if it's in an urban area, can we charge for parking? Is parking a premium, right? Do they want laundry service? Do they want, can we bill back for water? If the previous owner wasn't billing for other utilities, can we now recapture some? So as we're looking at this business on its own, we have to take all of that into consideration. And we'll get into this as when we get to the underwriting section of the seminar. We're going to go through all of this thinking, but I just want to let you guys know the word rent here really, we're just using it as an example, and this isn't directly correlated exactly to the number. but we are referring to increasing the revenue.
Yeah, absolutely. And you mentioned some of the good, income capture opportunities. Some of the other ones are, pet rent. Some owners don't charge for, pet rents. And, when you buy a new property, there's opportunity to implement, pet charges or, as you mentioned, storage areas and maybe even additional units. So it's really only limited by one's imagination, what you can do to increase rents and increase revenue.
Right. And this is obviously we're talking about apartments here. I know some of you in the room have Airbnb properties in short-term rentals. That's a totally different underwriting, and that's a totally different business. And many times that's a very active business that you're actually working in that business. This is all, apartments with third-party management that we're referring to. So, all right. Let's talk about deal flow. Key, why don't you start with this and then I'll interject.
Yeah, so deal flow is the heart of acquisition. And it's not as simple as, well, let's find a great deal. I just look at a lot of deals and try to find the best price ones, that's gonna, perform well. It sounds easy in theory, but there is a lot of challenges with deal flow. It's very different from residential transaction. When you think of a residential transaction, you call up an agent and say, hey, I'm looking to buy a 4-bedroom house in this part of the neighborhood, and this is my price range. And from that day on, your inbox is going to be just filled with just deals after deals, and you probably have opportunity to look at hundreds of deals. Well, for apartments, there's not as much inventory. Also, there's no platform like MLS or Redfin where you can just list your property and just expose it to just millions of sellers. There's less sellers and there's less buyers. And also, the sellers and buyers need to be qualified. What do I mean by that? It's very easy to buy a $10 product, from Target, right? You just walk in, you have the cash, you buy it, end of the story. Now, when you want to buy a car, it's a little more involved. The buyer has to qualify. You have to have enough credit to get a loan on the car. Now, when you want to buy a house, you have to have higher qualification where your debt to income ratio has to be right, your credit has to be good, and the bank want to know that you can pay for the mortgage. Well, when buying apartments, you need to have even higher set of qualifications. What I mean by that is the buyer needs to know how to underwrite the deal. The buyer needs to know that they can qualify for the loan, come up with funding, and be able to close on the deal. So the quality of the buyer becomes a lot more important for the deal. So for the seller, not only is it important to expose it to a lot of different buyers, they want to have the right buyer come to the table. Because what happens is if inexperienced buyer comes, they might hold up the deal for 2 months before it falls out of contract, and they wasted everybody's time. And this is where commercial broker comes in. There's a lot of different ways to get deal flow. There's brokers, direct marketing, and relationship with vendors. But I'll start with the broker relationship, because brokers are the gatekeepers to the deals. A lot of the deals in commercial space happens off market. You don't find it on MLS, you don't find it on Redfin, and where a broker brings a buyer and seller together and nobody really knows about it. And the value that broker brings to the seller is that they bring a qualified, the broker brings a qualified buyer to the seller. So the broker says, hey, Mr. Seller, I know you want to sell your apartment, for $4 million. I know the market and I know a lot of buyers. All these buyers are pre-vetted. I can bring a buyer, who has 100 units in the market. They've done deals just like this. They have a full team. They know exactly what they're doing. They have the ability to close. That's the value that a broker brings. So it's very important to develop that relationship with the broker. And because of this dynamic where the buyer has to be vetted, when you're meeting a broker, you're vetting them, but they're also vetting you. They want to know that the buyer is experienced, the buyer has the money, and that the buyer is serious.
Yeah, I'll add to that and say that as a broker, you don't need a lot of clients. And the reason is when you have a buyer, that buyer is typically going to be a seller. And so how many deals are we typically looking to do? So I think we've done in the last 2 years about 22 million. You don't really need that many more clients like us, right? And so having that relationship, that broker client relationship is super important. And I'll relate it to every other industry. Like, for example, there was a documentary on Netflix about SAC Capital, Stephen Cohen Capital, multi-billion-dollar, and he was generating like 30 to 40% returns or something like that. And it was all about inside information. Like, he had the inside connection to these different Silicon Valley firms, whatnot. Same thing with Nancy Pelosi. Like, they have all this inside information, and in real estate, it's no different. I think, as Keith shared, in terms of the MLS and kind of the open platform deals, the market pricing is the market pricing. But with commercial real estate, in particular, in our field in apartments, the brokers typically will bring a buyer that they've worked with previously and that are qualified to close. The last thing a broker wants to do is deal with, let's say, someone says, let's say Cindy comes in and says, hey, I will pay, $100,000 more than the last bid, right? How does the broker know that Cindy's going to close, right? And they get to the table and then Cindy said, oh, you know what? I want $75,000 off because the roof's not in good condition, right? So they have to have a track record with the buyer, and that's how typically they're able to access the best deals. One of the reasons why we also aren't expanding to different cities as quickly as we can is because we don't have that inside network. You can know brokers, but do you really have a relationship with brokers that are going to get you the best deals and you get the first look? And that's where I think we have a competitive advantage, and that's how everyone should do it. Is they need to have competitive advantages in the markets that they look at.
Right. I absolutely agree. And the other thing about the broker dynamic is that it's different from residential agent in a sense that commercial broker typically represents both the buyer and the seller in the deal. I mean, they have fiduciary duty to the seller, but there's really no buyer's agent involved. Because the broker takes the entire commission, and there is different dynamics where the buyer is not really represented. So as an investor, you want to make sure that the terms are reasonable and that you negotiate on your behalf. If you're not comfortable with that, you should at least have a competent lawyer look over the contract and make sure that the terms are reasonable and that works for your plan. With that said, it's really important to develop relationships with brokers. But if you're starting out, it's kind of the question, what came first, chicken or the egg, right? Because brokers want somebody with experience, but if you don't have experience, how do you get deals from brokers? And I think one of the ways you can do it is through relationships. When you partner with more experienced team, I think it gives you a chance to get some of these deals under your belt, so that when you want future deals, you have a track record. Nothing speaks volumes like actually having done a deal in the market. That's the power of the first deal. Once you do your first deal, a lot more deals come. As Dan, you probably remember, we're trying to get our first deal in Columbus. We flew out there numerous times, and we had meetings after meetings with different brokers. And we just had a ton of deal flow immediately after that, right?
Yep. So this was in 2019. So June of 2019, Key and I have been talking about starting this venture together, talking. I think September 2019, we made the website. And that was the start. That's all great businesses start with a website. And what we decided to do was we went through the same study that we did, that we showed you guys today, the study on how to choose a market, right? And if my thing would work, there it is. Okay, which was, we did the study on the market. What market had good population growth, what had good employment, yada, yada, yada. And we came up with about 5 different markets. I believe we came up with Columbus, we had San Antonio in there, and we had a few others. But as we were looking at it, we then sent out massive emails to try to connect with people. And we literally would not hear back from many people. Just said, you know what, we got to fly out there. So then we flew out to Columbus. We set up all these meetings with different brokers and, had coffee, whatever. And that was our first, foray into Columbus. Well, we thought that we'd get a ton of deal flow. Once we got back, there was nothing. It was just crickets, right? And so we're like, okay, we're not doing something right. So we kept on, we decided, okay, we need to keep hitting them up on a weekly basis. Eventually, we got our very first deal. And this was at the towards the end of 2019. And we had sold our property. So we now had a 1031 deadline that we had to meet, right? And so when we first got into contract, we went through a whole ton of questioning. We were scared out of our mind. And we were trying to analyze this thing 6 ways to Sunday. And we finally decided, okay, let's go. Let's do this deal. It was I think was it 32 units or 28 units? I can't remember exactly. But it was a former dormitory for a school that we were going to convert into an apartment building. And it was a 1990s or 2000 product. So it was fairly new. And we felt really, good that the building would be in great condition. On the week of Christmas, where we were supposed to finally sign the contract to buy the building, we get a call in the morning and the seller says, we found some other buyer that's offering us more than you. Sorry, no deal. And now that was probably the most deflating day in our tenure, where we just basically not only lost our first opportunity to do the first deal, but we also had a 1031 deadline that was going to get surpassed, right? So then we get to around February and COVID hits. Before that. So right around February, we get into contract on another deal, fortunately. We look at that deal and we're like, oh, look, the metrics look good, let's do it. We get into contract and then March COVID shutdown happens. And now we're like, oh, great. Like, what do we do? Is this like the death of the economy? Is it finally going to bust now? And we're in contract and we decide through a lot of really soul searching, hey, we underwrote this. We should have confidence in what we're getting into. If the market goes to shit, hey, everything's going to go to shit at that point. No one knows what the hell would happen. It wasn't that irresponsible. We still felt like, hey, as long as we can mitigate some negative rents or whatnot, we can do the deal. We ended up closing on the deal in May. Fortunately, the government extended the 1031 deadline due to COVID. And so we got everything done and it turned out to be a great investment. All that to say, as you can see, we went through a ton of challenges to get our very first deal. And typically kind of is that way, is that you have to really stay persistent, you have to really want it, and you really need to put the effort in. And so same thing as we go through today and through this whole boot camp is like, you really have to want to create this new vision and this new path of your journey, because it is a lot of work. It does take a lot of effort. And ultimately you'll reap the rewards, but it is a patient game. There is no shortcut to getting to where you want to get to in terms of your net asset worth. So.
Right. Our first 2 deals were pretty rocky, but part of the reason for us to close that deal was our reputation and relationship with the broker. We thought, hey, you know what? If we back out of this deal, that broker is never going to bring us another deal. And he was one of the top brokers in Columbus. So even though that wasn't the only reason, it was definitely part of it was part of the equation that we thought, hey, you know what? It's really important to do what we say and to be known as closers. And as a result of that, we've done 4 more deals with the same broker, and he gives us the first look at many of these deals. As a matter of fact, our latest deal that we closed on we were the only one that actually looked at the deal, and we got to do that, off market. So, again, it goes back to the power of relationships. And Danny, you want to go back one page? And this is why the relationship with broker can give a group a huge advantage. So we talked about how the buyer vets the broker, but the broker also vets the buyer. So when you talk to a broker, you want to communicate your confidence, competence, and seriousness to buy the property. As Dan mentioned, they don't need any more buyers. They have plenty of buyers. They need more sellers. So it's up to us to convince the broker that we are A players, we can close on the deal. So how do you actually do this? One way is to fly out there. That shows a lot of commitment. When you live in California, you fly out to Columbus. Hey, Mr. Broker, I flew out here just to meet you. That speaks volumes. It's a lot easier to just pick up a phone, write an email. It's another thing to fly out there on the airplane. So how do you find these brokers? One of the ways is to go to the major website like Marcus and Millichap, CBRE, and see the listing brokers. Another way is to see who are the players that's getting the deals done. There is what's called LoopNet, and LoopNet.com is kind of similar to Redfin or MLS. There's a joke saying that LoopNet is where deals go to die, because the deals only go to LoopNet after everybody's looked at it and most people passed on it. The last ditch effort to sell the property is, hey, let's post it on LoopNet and see if we get any bites. So it's not a good way to find deals. I mean, I've heard of deals getting done on LoopNet, but the real value of LoopNet is it allows you to see who the players are. So when you look at a broker who has a lot of listings on LoopNet, you can connect with them and say like, hey, I saw a deal that you had on LoopNet. I have some questions on it. Ask some thoughtful questions and explain to them why the deal wouldn't work for your strategy, but this is the criteria that I'm looking for. Do you have something like this? If you have a deal that fits this criteria, can you send it to me? And that's a way to have that initial conversation with the broker. And that's what we did as well. For Columbus, we reached out to a bunch of brokers on LoopNet, and that got our first engagement with the broker.
Yeah, and like you mentioned, it wasn't just simply saying, hey, this deal doesn't work, send me a better one. Everyone wants a better deal. But what he did, he took the extra step of actually underwriting the deal and pinpointing exactly why it wasn't working. And that also was able to refine our relationship with the broker. So the broker knew exactly what type of properties we're looking for. And I think the more specific you are, I think it does also help the broker really identify and come and have you come first to mind when that type of property does come on market or they're able to get it. The other thing we do also, by being very specific in terms of the asset that we're looking for, is that they will phone their own clients who have that specific asset, but who did not approach them about selling the asset. So that's a trigger for them to now reconnect with their sellers and with their buyers that have properties in the local market, and to then say, hey, would you sell if I brought you a buyer? And that's a great conversation starter for them, and they appreciate that. So the more specific we are about the asset type, about the building type, the year, et cetera, they will then be taking you more seriously. And then, top of mind, they'll look at properties that they may have sold previously or have had that they can really go target. They don't care if they sold the building 8 months ago to someone. They will go back to them and say, hey, do you want to sell your building for a profit? So they're just because a building traded hands within the last year, it doesn't mean that it's off market for the next 3 to 5 years. No, there's always a deal to be had.
Right. So when a broker looks at a buyer, there's few questions he has in mind. The top 3 might be, does the buyer have the money? Meaning, well, does it have it in his bank account? A lot of times, people syndicate or they raise money to buy apartments. Like, do they have the capacity to come up with a down payment? Do they have the money? The next question is, does the buyer have experience and knowledge? And by this, I mean, does the buyer have enough experience where they know what to expect? Where, if this is a 1970s product, where on the due diligence, if they see, a couple of leaks and then they see old roof, are they going to just panic and then back out of the deal? Do they know what is par for course? Do they have a lender in place? Do they know what the qualifications are? Do they know the due diligence process? Do they have relationship with the property manager? Do they, not having a team in place and not having done a deal is a lot of concern for the broker. So they want to know that the buyer has experience and knowledge. And as Dan mentioned, by being specific about what kind of property you want, that communicates knowledge and confidence. By knowing, hey, you know what, I want to look at value add properties built in 1960s and 1980s with 20% upside in rents, but no heavy, deferred maintenance. I want it in this part of town, and I'm going to exit in 3 to 5 years. This is a lender that I'm going to use with, this types of financing. And that, by communicating that, the broker can have more confidence in the buyer team. Last but not least, he wants to know that the buyer is serious about buying. And, this is where reputation goes a long ways. Nobody wants to really have the deal fall apart. And if the buyers have a track record of backing out of deals or trying to retrade is trying to negotiate after, you agree to a certain price, the broker and the seller is going to be really nervous. So as buyers, you want to establish a reputation as a group that does what they say they're going to do and that close on deals and that don't retrade. And some of the ways that you can do this is just, little things. There's a saying, how you do anything is how you do everything, such as doing what you say you're going to do and being on time, responding to their emails. When they send you deals, underwrite and, get back to them, instead of just emailing them back, give them a call and say, hey, Mr. Broker, thanks for sending me this deal. I analyzed it. And for X, Y, and Z reasons, it doesn't quite fit our model, but I appreciate you sending the deal. Keep an eye out for some, more deals like, what I told you earlier. And doing this, builds credibility, trust, and respect, from the brokers. There's the 90-10 rule in commercial real estate when it comes to finding the best brokers. Earlier, we talked about using LoopNet to find the best broker. Another way is through relationships. When you talk to bankers, when you talk to property managers, you can ask, hey, who is the best broker in town? I always like to ask for referrals. When I'm working with, one vendor, I ask for, other vendors in the market. So there's a saying that 80% of the result comes from 20% of people. Well, in commercial real estate, it might be more like 90-10, where 90% of the deals might be done by 10% of the brokers. So it's really important to know the top players in the market. And as I mentioned earlier, one of the ways is to see who's really active on LoopNet, who's done a lot of deals, and also through reputation. Who's a weak broker if the only deal they bring is not their own, but somebody else's deal, or if they keep bringing you market deals. There's some brokers that only bring us market deals, and we're like, hey, I saw this deal already. Can you bring any off-market deals? So strong brokers are the ones that has relationships with all the sellers, and they have all the off-market deals in their back pocket. Now, we talked about building relationship with best brokers. You want to keep in touch, try to reach out, at least once every couple of weeks. And, have a reason to, email them or call them, maybe mention an article about the city, like, hey, I saw that Intel is supposed to be coming into Columbus. How do you think this will affect the market? Or, ask about their particular deal that they have on LoopNet, something like that. But maybe there's a common interest on a personal level that you can talk about, but find a way to stay in touch. And, you want to be in the forefront of the broker's minds. Now, with brokers, it's going to take some time. I mean, even for us, it took a while for us to get our first deal. I think it's just matter of persistence and just staying at it. Now, couple nuances to commercial real estate deal is that some brokers may ask for exclusive representation. And what it is that commercial real estate agent basically has you as their client. And whatever deal that you do, whatever you purchase, they are entitled to the commission. Now, this can be problematic because if some other broker brings you the deal, you still have to pay this guy the commission. So you have to pay double commission. And I think this is more common in residential real estate transactions, but some commercial brokers will also ask for exclusive representation. And we have some brokers ask for this. And from my experience, the best brokers never ask for exclusive representation. And it's, I just don't think it goes well, for anybody's business plan.
Yeah, I would say it's a difficult proposition, but I understand why, because it does take a lot of effort to try and hunt down deals. And, while they're hunting down the deals for you, and then you go buy another property, well, without any promise of compensation, well, they wasted a lot of time. And that's why a lot of brokers don't like being buyer representatives. This is the same thing in residential. They don't like being buyer representatives. They all want to be on the sell side because they control the listing and they have the power, and all the buyers will come to them. And many times because of that, they don't need to cooperate on their broker commission. So, it does get like a touchy subject.
Right. One alternative to exclusive representation is property specific exclusivity. And what I mean by that is if a broker brings a deal to you, that if you buy that deal, you owe that broker commission for that particular property only. It prevents the buyer from going around the broker and going directly to the seller or another agent. So, whenever a broker asks for exclusive representation, we offer them property specific exclusivity. Last but not least, one of the things I mentioned earlier is that the broker, works the buying and the selling side of the transaction, but ultimately brokers have fiduciary duty to the seller. This means that the buyer really doesn't have representation. You want to make sure that you negotiate on your behalf or have a competent lawyer, look over contract and other terms so that your interests are represented and that terms are reasonable.
I'll flip to the next. This is our last slide. I guess I'll cover some of the direct marketing, because we did think about doing direct marketing to sellers. So we got a whole list of owners and people that own apartments. But one of the things that we realized was that brokers don't like that. So if you decide to go and do kind of a mass mailer targeting owners, and if that gets back to the brokers, they will look at you as their own competitor, because at the end of the day, naturally they're going to think, well, you're trying to do the deal on your own without the broker in the middle. And so they will look like, you can come off as their competitor. Now, in terms of like apartments and larger assets, it's never really done on a one-to-one basis unless they've known each other for a long time in terms of the buyer and seller. Very, very often a broker is in the middle, and there's multiple reasons for that. The broker has their Rolodex of buyers, but there's also risk where the broker will be some form of risk mitigation for the seller as well. But many times the broker gets in the middle of it, and these are large assets for large profits. The seller doesn't want to have to deal with it, with the showings, arranging all of that and things of that nature.
Right. So I think direct marketing works better for some of the smaller deals. When you're looking at 10 units, 12 units, 20 units, there may be more mom and pop owners who may be open to just random offers that come in, via postcard or by phone. But when you're dealing with 50 units, 100 units, 200 units, a lot of these owners are more sophisticated and professional investors. They have LLCs in place. It's hard to track them down, and they don't just want to sell to a random person that called them. Like I mentioned earlier, you want to make sure that you vet the buyers. They need to know who the buyers are, if they're qualified, and if they trust them to close on the deal. So it's a little bit harder to call up an owner of a 200-unit apartment and say like, hey, Mr. Seller, I'd like to buy your apartment. It has been done, but it's very few and far in between. So for those reasons, we mostly rely on broker relationships for the deals. And to sum up the broker relationship, it's that they're the gatekeepers, and they're the ones that bring sellers and buyers together. We need to vet the brokers, but broker is also going to vet us. We need to communicate our confidence, competence, and ability to close in order to get good deals. We need to build and maintain relationships with brokers through accountability and persistence. And it will take some time.
And almost all brokers will also say, keep hounding them, because they don't have every day that you're on top of their mind, but they will never get mad at you continually hounding them and catching up with them and talking to them. So, don't be shy about that.
Yeah, and I think another way to add value to brokers on a practical level is maybe offer some introduction. If there's like a lender, if there's a property management team, if there is another buyer that may like the property, even though you don't like it, by making those introductions, you are directly adding value to the broker. And this goes the same for the lenders and property managers as well. If we look at a deal and we don't like it, we try to think who else might like it. And by making introductions to other players in the market, we're building relationship capital, and that results in also deal flow as well. Not only we get most of our deals from our brokers, but there's also opportunity to get deals from property managers, from lawyers, contractors, even bankers. One of the deals we closed on this year actually came from our banker. He called us and said like, hey, this deal just fell out. I think you guys are the perfect group to take this down. He gave us introduction to the broker, and we looked at it, and sure enough, we loved it. We're like, hey, this is a great deal. We'll take it down. We immediately put it under contract. We closed on it. The banker was happy. The broker was happy. Seller was happy. And we are in contract on another property through the same broker. So these relationships just really pay dividends that you can really put a certain value on. And a lot of our properties also came from our property managers. The first property we looked at in Columbus came from property manager. One of our properties in Reno came from a property manager. So by having these relationships and letting them know that you're looking to buy, it just opens up the doors and brings opportunities and serendipities that you might not have thought of.
Yeah. So we covered a lot, and I know on many levels we did kind of stay a bit higher than maybe some people wanted. So what we want to do is we're now at the end of 90 minutes of this session. As I mentioned, we want to split it up into 3 sessions so that everyone has time to digest this. The next session is going to be about acquisition. Really, we're going to help build your model. We're going to talk about how to raise the equity, the debt. We're going to talk about the different types of debt. And, alluding back to Jen's question before, the debt's going to follow the type of investment it is. And you want to make sure you put the right kind of debt and equity on there. And then in the last section, we're going to talk about how to acquire your first deal. And we're going to go through a step-by-step process of doing so. So with that said, I'm going to open it up now and see if anyone has any questions. And by the way, I just put my email into the chat. So if you guys have any, if you guys want to email me, I'll email you guys this presentation as well as other resources in terms of how to find the market, to invest in. So With that, I'll just leave it up for any questions that you guys may have.
Yeah, if you want to ask a question, go ahead and unmute yourself.
Maybe I'll ask this question. Is anyone on right now going through an acquisition currently?
Me.
Oh, okay, nice.
I was discussing with Key.
Oh, where is the acquisition at?
It's in Eastern Canada, and I'm actually just about to leave for the airport in a few minutes to fly out and do the walkthrough. So.
Oh, wow. Okay, great. Good luck with that.
Thank you.
I also have a broker that sent me a package of 77 units in Cleveland, Ohio. She just sent me the financials yesterday, so I'm kind of trying to walk through doing a brief underwriting now to see if it actually pencils out as a deal.
Yeah, that's great. Do the records look pretty good?
From what I've seen so far, it seems like it is somewhat, but an occupancy rate is really low. But I need to do some more digging as far as the rent currently and the pro forma rent she mentions, because the seller also is the property manager.
Yeah. That is like one of the most important parts of our, acquisition is the underwriting and making sure that the records are normalized. So many times you guys will see the deal flow, like on LoopNet primarily, and you'll see brokers advertise via an offering memorandum, what we call an OM, and they'll state all the financials and the cap rate. The cap rate is basically a barometer that people use so that they kind of value the property, between each other, right? And you'll see these cap rates noted as 5 cap, 6 cap, 7 cap, whatever. It is one of the biggest bullshits like in the industry. It's you almost can't rely on any of it. And so you really have to get the financials from the seller or the property manager and really underwrite it on your own, also making your own assumptions. And we'll go through all of this on our next session because we are going to cover underwriting. But it is one of the most frustrating, exercises to do, but also one of the most important aspects of doing an acquisition.
Right. Hey, Steve, not to put you on the spotlight, but you had a recent acquisition. Maybe you can share maybe some of the challenges or questions you might have about operating your, first apartment complex.
Are you asking me?
Yeah.
Oh, so so I think like what your partner mentioned earlier, we recent 2 months ago we acquired 12 units, and we tried to get a financials T12, and the thing is we can't even get all the information we wanted, and then once we get them, it's just a mess, and you can't even like calculate the correct the cap rates, etc. Like for instance, like the water bills. Some months they don't have any, some months they do have it, and stuff like that. So yeah, it all require like kind of like additional research on, hey, how much is it really going to cost by calling, the cities, and like for other expenses, like like when you take their financials, you want to like use it as a base and a foundation, and you got to layer in what you really think that really gonna cost you, and that's how you can underwrite and get the value you get out of it. The other challenges we have is finding the property manager, especially for a property that it's needs like work, because there's some like a fence, I mean like a railing, it's kind of loose and not secure or not up to code, and leaks and all that. Finding a good property manager that can help you, especially when you're out of state, it's a key. So we had to we find one that it's just not very good and not responsive. So we had to kind of like fire them, and then going through the process of getting a new one too as well. So yeah, all of those is pretty crazy. Like, I mean, we're based in Denver, and then the property we got it's in Kansas, which is like, I mean, it's not too far, but like still 10-hour drive or another plane flight, but we can't be there every day. So it's these are the challenges that we have right now.
Right.
Yeah, Steve, I think finding the right property manager is another huge challenge. And this is why, many people, they talk about real estate as passive income. And, if you own the real estate and you operate it, there is no such thing as passive income. You really have to be on top of your property managers. You have to, audit their financial statements. You got to look at the fees that they're charging. Many property managers, if you think about it, their base fee is somewhere between like 4% to 8%, or whatnot. And for vacation rentals, it's more than that. But it's, when you think about the grand scheme of things, that's not a lot of money. And so where you see them padding a lot is on their expenses. So they'll hire a plumber and whatnot. Maybe the plumbing fee is 150, but they'll charge 250. And so you really have to look at everything that's going through the books. And as well, one of the properties that we're underwriting, we looked at what the property manager is charging on top of it. So we had to normalize it back to, what we would pay our property manager to manage it. And so it does take a lot of work, but as you mentioned, finding the property manager is key. We've actually fired a property manager. But going back to our vision and our ethos, we really want to try to work with who we have. We want to make sure that we're very transparent with them in terms of what's not working and what's working. We want to encourage them to continue doing what's working. And we want to be very, upfront and catch it early if something's not working. But those conversations are very professional conversations, because at the end of the day, we're all in it to perform on the asset from the investment perspective. And if it's not a good fit, it's not a good fit. When we fired our first property manager, it wasn't that they were a bad property manager, is that they were not the right property manager for our strategy. So it's really important to find a property manager that is aligned to your strategy. And so it's really important to also tell them exactly what your strategy is. Is it that you want to turn 12 units in 1 year? Or is it that you want to be organic in those turns? And so all of those things are really important when you're vetting a property manager.
Yeah. I think one thing I totally agree is that how much you pay them. I used to be like, hey, let's get a lower 7%, 6%, kind of like a property management arrangement. And recently, we learned is that, hey, it was like between 7 or 8%. I was like, hey, let me give you 8%. Because I need you to help me to turn the things around. Because you gotta give them like enough motivation to put their time in there, efforts in there. I mean, that 1% difference, I can make it up in a different way, right? So
right, exactly. And when you look to sell, and let's say your property management expense is really high, the buyer will normalize that back down to where they think they can get their property manager to operate at. So it won't always be a penalty back to you.
Right.
Yeah, Steve, I think the other thing you mentioned is also true, where it's really hard to make sense of the financial statements. When you're trying to underwrite the property, a lot of times people think it's simply mathematics. Okay, I get the numbers, I plug in the numbers, I get to see if it's a good deal or a bad deal. Well, half the battle, or more than half the battle, is reading between the lines or trying to translate what the financial report is telling you, because most of the financial reports you get from the sellers will be incomplete or inaccurate, and it becomes necessary to actually figure out what the numbers mean. You got to read between the lines and figure out the underlying theme. It's sort of like puzzle work. You're trying to figure out what the true story is behind the numbers. It's an art more than a science. Would you agree with that, Dan?
All of real estate is like an art to me. I don't know if there's any science involved. It's interesting because today we covered quite a bit, but one of the main things that we want to talk about was market selection. One of the things about the market selection that's kind of interesting is that again, this is also kind of an art and a game of connections, is that we've learned that it's not just about getting into a good market and into a good deal. That local market needs to have a lot of workers, and there has to be a supply of tradespeople that you can rely on. For example, in Reno, we got into great deals, but it's really hard to find a plumber because there's so much construction going on in Reno. Everyone's developing. The growth is ridiculous. Tesla's expanding, Panasonic is expanding, and everyone is taking these tradespeople into their larger projects. So it's very, very hard to find a contractor that can go in and really work on your property. We would have plumbing bills of like $800 sometimes. And that's just, something that we're not used to seeing. But if you want to get something done, it's like you have to pay a premium to have them move up on the food chain, on the list of clients. So it is interesting. So the metrics for market selection, again, I'll send you guys some qualifiers in terms of the metrics that we look at before we select a city. But there's other things that we really need to consider, and one of the most important things is, do you have a team? So as Steve was mentioning, when you find a property manager, you almost have to start in reverse. Like, you have to find a good property manager that once you're in acquisition, that you can put them onto the project and feel confident that they're going to perform. They also will help underwrite the property. So before we acquired our property, we met our property manager that we really liked. They actually brought us a deal as well, and we underwrote the property, but they were able to verify whether the expenses and the rents were achievable. And so it really behooves you to work with a good property manager that's going to be part of the team, even the broker, and really look to see if your assumptions and the pro forma for the future make sense. Any other questions about either the presentation or about anything that you guys might be going with that we can help maybe answer? Okay, good. Well, with that, Key, do you have any other thoughts before we close in?
No, thanks for making time out of your busy Saturdays. Love seeing all of you guys on the webinar. And like Dan mentioned, this is going to be a 3-part series. On the next one, which we're going to hold the Saturday before Thanksgiving, I believe it's November 19th. We're going to cover underwriting and different debts, different loans that's available for commercial real estate. So we hope to see you on the future webinar, and thanks for coming out.
Yep. And please send us any questions or any feedback. We love feedback. This was actually our very first session, so it'd be extremely helpful.
Here at DC, how do you guys communicate the links for the next session and stuff like that? Like a key, because I got it from the message from you, like, but for the Zoom link next time.
Send us an email if you guys want to attend the second webinar, and then we'll definitely keep you posted of the next one.
Can you guys send us this? You guys recorded the session?
Yeah. We recorded it, and we'll send you the deck.
I'm gonna turn this into my own masterclass and profit off of it.
Good luck doing that.
Hey, Key at DC. I don't know. I know it's wrapping up. I do have a question. I was curious.
Sure.
When you guys get into those multi-units, let's say in these value add, and you guys are in California, you're not going to live there every single day to project manage. And when the unit needed to renovate, to bring it up, do you rely on general contractor or PM, or do you rely on contractor also hands-on? What is your approach to find it to get a job done?
It's been a learning process for us, and that is one of the toughest part of the equation. It's very important to find good workers. I think sometimes people expect the property manager to just take care of everything. In a perfect world, that may work, but we found out very quickly that property managers are not necessarily general contractors. A lot of the companies are kind of used to dealing with apartments or rental units that is not a value add, meaning when a tenant moves out, you go in, do a light cleaning and rent it out again. But when you're trying to turn like 4 or 5 units, do pretty big renovations, that's a whole different animal. So, we actually ended up hiring contractors directly, and we have the property manager check in on the contractors periodically, send us picture updates. And, it's not a perfect system, but it works better than just relying completely on the property manager. Because when we initially relied on the property manager, the projects took a lot longer, they cost more. And when we took it over, we were able to get it done faster and better. Dan, you want to elaborate on that a little bit?
No, I think you hit on all points. It really depends, Steve, on multiple factors. But are you referring to just when a tenant moves out, or kind of after you acquire the building, implementing a value add strategy right away?
Post acquisition, yep. Right
Okay,
away.
and are you taking it with a lot of vacant units, or are they all fully occupied?
Fully occupied. Yep.
Okay, so then you're gonna basically probably look to do a rental increase strategy, right? And then try to get back maybe 2 or 3 units. Do you have a contractor right now?
We kind of do. We do.
Okay, yeah.
But with everyone being busy, it's been 2 weeks and I haven't get a quote yet. I was like, "Do you want money? Do you want to do it?"
Right. No, it is challenging, but also, do they know the extent of the renovation that you want to do?
Yeah.
Okay, so they have a scope of work that you've provided them.
Yeah. So I was thinking, like initially, like he said, I can't rely. Initially, I was like, oh, I'm gonna rely on this PM because he's gonna do he or she gonna do it because I pay him, kind of thing. But their really expertise is running, like managing the property rather than like being a contractor. So I think I might come down to like I needed to, interview a few more general contractor or contractor to kind of like work it through myself rather than rely on that contractor because it's not happening right now. So
Yeah, and there is also a consideration that you could do, which is how much renovation do you need to do to impact the rent? Give you an example. We have a certain design that we want our finished product to look like, but on some of our properties, we decided to go with a more compromised design to get it back into the market much faster, because we realized we didn't need to go to the full extent in order to realize the rent that we can capture. So when you're having a difficult time trying to locate the right contract or whatnot, but you want to try and realize the rent, maybe there's some compromise you can do on the construction so that a handyman or your property management company can take care of.
got it. Yeah.
Yeah, I think it really depends on what class asset you have, right? If you have class A asset, you want to make sure that you have the most modern, beautiful finish. But if it's workforce housing, class C, it's really easy to over renovate. If you put in marble countertop, you might not get the return on investment that you might get a class A property. So depending on whether it's class A, class B, class C, and then depending on the market comps, you want to have a really good idea of what kind of finish that you want and what kind of design that you're looking for.